Tobias, how do you even wrap your head around a potential global pandemic? The WHO is not calling it that, but judging by yesterday's action in the stock market, that was clearly a consideration.
So, look, I think the market was vulnerable already, coronavirus being kind of the catalyst right now. We have to desperately not lose sight of the human tragedy in this all. But sentiment was really stretched. Our panic euphoria model was in euphoric territory, sending a 70% probability signal of a down market. Household equity exposure as a percent of financial assets is already at 50-year highs. So it's not like there's a lot of dry powder sitting on the sidelines. And number three, earnings revisions that were already slipping even before the coronavirus kind of data started coming out. So the backdrop was vulnerable already. And then you have this, horrific event occur with most of the information. I was at our industrials conference last week down in Florida, listening to companies, and I'll give you one example. One company noting that they have 100 different suppliers into their facilities in China, both local and global, selling 500 different kind of components. The logistical nightmare of trying to get that up and running properly is, kind of a problem when you hear about schools in Hong Kong staying closed into April.
So, John, how long are you looking at as far as economic disruption? Is that even possible to tell if you're looking at things like supply chains, factories trying to get reopened, and consumers on the demand side as well?
I don't think it is possible to tell exactly, but I think what we know is that it is a short-term rebound thing, not a long-term you're dead thing for the economies in any case. The recent data are really very bad in terms of shipping and container usage and so forth. And they're going to get a lot worse as in the coming weeks companies use up their inventories of components and parts from their supply chain partners. But that's we've seen this movie before. I have an entire shelf, Sarah, of books on plagues and pestilence. I study epidemiology and I teach it in graduate school at the finance level. There's lots and lots of data on how epidemics work. They work fast. You come back from it. There's a lot of data on recently in China from SARS and the bird flu epidemics. Both of them were worse in any metric you want to make than this one is so far. The swine flu was worse here in the U.S. in 2010. So I think what we're really facing here is short-term economic things that are happening and short-term market responses. One of the things I teach also is behavioral finance. There's a new bias I'm inventing called the Armageddon bias, which means whenever we see terrible news like this, we think the entire world's going to end. The entire world doesn't end really very often. And so this is an incredible opportunity to buy slowly and carefully only the Robinson Crusoe stocks, the ones you would own for 50 years if you were on a desert island, and the ones that are especially in people's sights about the coronavirus. So this will pass, and we will end up with markets and economies back to normal again at some point later this year.
Did not know that you had that expertise in studying viruses, John. So make the case for it sounds like you're making the case for a V-shaped recovery. Increasingly, there's talk on Wall Street about a U-shaped recovery, which would not be sort of as robust in terms of a comeback. Why do you see it as a V?
Well, it's because it's for two reasons. The non-technical reason is because this is happening because ships can't move, containers can't move, workers can't get to work, and people can't get to the store to buy stuff. And so all of those things end at a certain moment when the all clear is sounded from the actual contagion itself. The technical reason is because transport of goods and production of goods in terms of the network of resources are actually distributed in a way more like economists think is normal. That is, not too many great, big and little episodes. Financial markets, however, are distributed very differently. It's called a power law, but basically it means you have huge ups and huge downs that happen, which means the risk is more on the financial markets. Chinese debt, Chinese shares posted as collateral for debt with banks, banks' inability to get working capital to Chinese companies because most of them were private and didn't use the big banks, and so forth. Short-term financial crisis issues.